The U.S. economy may seem strong, but under the surface, experts are deeply concerned. First, America's national debt has crossed $34 trillion. That's more than the entire U.S. economy produces in a year. Paying just the interest on this debt is now one of the biggest government expenses. Second, inflation. Even though the Fed raised interest rates, prices for food, housing, and fuel remain high. Millions of Americans are struggling to keep up, living paycheck to paycheck. Third, in 2023, banks like Silicon Valley Bank and Signature Bank collapsed, reminding everyone that the system isn't as stable as we thought. Fourth, many companies are laying off workers due to automation and AI. In fact, over 300 million jobs globally are expected to be affected by AI, and the U.S. is at the center of that transformation. Finally, the stock market is overheated. Big tech stocks are at record highs, and some analysts warn we may be in a bubble, just like in 2000. These warning signs are real, and experts say if we don't act wisely now, the next crash may hit harder than the last. Every year, the U.S. government hits a dangerous limit, the debt ceiling. It's the maximum amount of money the federal government is allowed to borrow. But here's the problem. America keeps spending more than it earns, so Congress must vote to raise the ceiling or risk defaulting. In 2023, the U.S. came within days of defaulting for the first time in history. That means not paying military salaries, Social Security checks, or even interest on its loans. The entire world watched because the U.S. dollar is the global reserve currency. If the U.S. fails to pay its bills, global markets could collapse. Even the threat of default has consequences. In 2011, a similar crisis caused America's credit rating to be downgraded for the first time ever. The stock market dropped, interest rates jumped, and confidence in the U.S. economy shook. What's worse, the debt isn't shrinking. It's growing by trillions every year. In 2024 alone, the government added over $1 trillion in just 6 months. Politicians keep fighting over short-term fixes, but long-term solutions? Nowhere in sight. Experts warn that if America defaults, even once, it could trigger a financial panic, destroy trust in the dollar, and spark a global recession. The debt ceiling might sound like politics, but it's not just headlines. It's about your future, your savings, and the stability of the global economy. Stock market bubble burst. Big tech stocks like Apple, Microsoft, and Nvidia are at record highs, pushing markets higher and higher. But some economists warn this could be a bubble, just like in the year 2000. If investors panic and start pulling out, markets could crash, wiping out trillions in wealth, especially for middle-class Americans relying on 401ks and retirement funds. 3. Commercial real estate crisis. Since the pandemic, office buildings across America remain empty. Companies have embraced remote work, and major cities are seeing downtown buildings lose value fast. This is hurting regional banks that gave out massive loans for commercial properties. A wave of defaults in this sector could cause banks to fail, similar to the 2008 housing crisis, geopolitical shock, or global conflict. The U.S. economy is tied to global peace. A war in the South China Sea, a Taiwan conflict, or oil supply disruptions from the Middle East could spike prices, hurt trade, and cause economic instability. Just look at how Russia's war in Ukraine raised gas and food prices worldwide. Imagine something bigger. A major U.S. debt default. We're dangerously close to the edge. If Congress ever fails to raise the debt ceiling, or delays too long, America could default on its payments. That would damage the U.S. credit rating, tank the stock market, raise interest rates overnight, and cause global panic. The dollar's reputation would collapse, and so would the trust in the U.S. economy. How can Americans prepare for a crash? 1. Build an emergency fund. First and most important, create a financial safety net. Experts recommend saving 3 to 6 months of essential living expenses. That means rent or mortgage, groceries, transportation, and utilities. If you suddenly lose your job or prices rise fast, that cash could save you from falling into debt, or worse. 2. Cut back on high-risk spending. Now is the time to be cautious, Avoid piling on credit card debt, luxury purchases, or speculative investments. In an economic downturn, access to credit gets tighter, interest rates rise, and banks get stricter. Live below your means, not beyond it. 3. Diversify your investments. Don't put all your eggs in one basket, especially not in just high-growth stocks or crypto. A smart portfolio includes a mix of U.S. Treasury bonds, safe during chaos, precious metals like gold, low-cost index funds, some cash in a high-yield savings account. Balance is key to surviving market volatility. 4. Invest in yourself. One of the most powerful ways to prepare is through education and skill building. The job market is shifting fast, especially with AI and automation. Learn skills that are in demand: cybersecurity, data analysis, healthcare. Skilled trades, those who adapt will thrive, even during a recession.